Thank you, everyone, for coming. So data centers have come a long way. Once considered energy hogs are now factories of tomorrow. IoT, AI, machine learning, virtual reality, autonomous cars, and 5G wireless have all been drivers of demand. In fact, no other asset class has the global reach, global growth projections, and investor appetite like data centers. Established data center investors are now finding it harder to compete as several new and well-capitalized investors are entering the market, such as private equity firms, pension funds, infrastructure funds, and real estate funds. With the emergence of edge computing and the race to build hyperscale data centers, how is this industry evolving? On this panel, we will discuss trends in the capital markets, talk about the various growth strategies, and then find out what headwinds or tailwinds are expected in the near future, and then we'll open the floor for questions. So let's get started by letting our panelists introduce themselves. Let's start with Edmund on the very far right.
Thanks, Miles, for having me on this panel. My name is Edmund Tan. I'm the Senior Director in AirTrunk with the Treasury Department. I'm a relatively newcomer to EdgeConneX. I've only been with the firm for about 3 months. Before that, I was a TMT banker for about 20 years. And most recently, in the last 9 years, focusing on the data center market and providing data center financings to the operators in the Asia-Pacific region.
Sam?
Hi, good morning. My name is Sam Lee. I'm the Managing Director for EdgeConneX, in charge of corporate development across the APAC region. I've been with EdgeConneX now for about 3 years. I just got the reminder from LinkedIn last week, so it reminded me that it's been a pretty enjoyable, crazy and fast journey. I can't believe 3 years have passed in such a short amount of time. But I've been in the region now, based on Singapore, for about 20 years. So happy to be here, and thank you for having me today.
Marcin Nowakowski here. I'm heading up Telecom and Tech Industry Group for APAC and Natixis. Been in the industry for the past 20 years. Maybe awarded Natixis. We are a global corporate and investment bank headquartered in Paris. We have been extremely active in the digital income industry for a couple of decades. We have the privilege and honor of working with a lot of our fellow panelists here on the stage, as well as in the audience. I think with AirTrunk we have close to a decade-long institutional relationship. With Sam and EdgeConneX, we've supported their developments across 4 continents and probably a dozen of markets. So great pleasure to be here, and thank you, Zhao, Miles, for having us.
Thank you. My name is Miles Loo. I'm with Newmark. I've been in commercial real estate on the valuation side for 30 years, and I started the very first data center valuation practice anywhere 20 years ago. I built a team. We have the largest team, and in the last 12 months we've completed over, somewhere between 800 or 1,000 valuations across 6 continents, and that's over 85 billion US dollars. Okay? So let's first begin talking about AI and how it's reshaping the data center landscape. Earlier this year, the number of hyperscale data centers passed the milestone mark of 1,000 hyperscale data centers worldwide. In a recent report by Synergy Research, the capacity around the world will be doubling over the next 4 years, and at the same growth is expected to continue for the next decade. So Marcin, you've been involved in TMT, you said, for 20 years. While this growth seems impressive, some of us might be wondering if it's sustainable. Could you explain what factors are driving this rapid expansion, and whether we can realistically expect the same pace to continue for another decade?
Thank you, Miles. So I think the answer is yes, right? I mean, whereas in Asia we're very much seeing deployments focused on cloud rather than AI, there is still a large degree of enterprising moving to digital. We're not yet witnessing the sort of wave of AI deployments that is very much prevalent across the US or certainly some of the European markets. But AI, broadly speaking, is a fundamentally different opportunity and a different set of challenges for operators and financiers alike. We don't think the demand trajectory will change. We think the demand driven by AI applications that carry the premise of really influencing or changing the productivity across all major industries is here to stay. This is well supported by the CapEx programs we're seeing by global cloud services providers. and we're here as a finance industry to support infrastructure developers in catering to those to that demand, which we certainly see continuing and coming to Asia in a major way as we see it today.
Okay. Sam, whether it's AI workloads or cloud workloads, everyone's wondering, where is it going to land next? Johor is surging, but how do factors like data sovereignty, regulations, and geopolitics impact site selection and financing for infrastructure?
Yeah, I think, again, Malaysia and what you see happening in Johor is a perfect example of how the different elements that support our industry growth and development of the sector kind of commingle together and present something that makes it quite interesting and unique opportunity. Malaysia, we all know the elements have been there for quite some time. They've had vast amounts of land, and there's a cheap land. They've had surplus of power. But what's happened over the past few years is that you have a government who's been quite proactive in supporting the digital economy. They've welcomed investments, they've opened up the nation, and most importantly, there's been quite a bit of political stability, which it didn't have probably for the past 3 years, for the period up until about 3 years ago. And so being infrastructure and the long-term nature of the investment life cycle, it made it very risky to invest in a country like Malaysia. But now, as those risks continue to be mitigated, and a market like Johor, for example, becomes more well accepted, you're able to get financing, you're able to get customers, you're able to get competition to come in and really validate that market. It's helped to grow and essentially validate markets like Johor. I would say in places like Jakarta, you do definitely see the underpinnings of the beginning of that. So I'm confident and quite optimistic that Jakarta and even markets like Bangkok will follow suit in due course. But again, one of the themes of the discussions over the past, whether it's been during networking sessions or the panels yesterday, is that you follow the demand. Where are the people? Indonesia is a country of 200 million people with internet penetration still shockingly low. It's still in the 50% range. And so going back to your earlier question about the runway, will there be sustainable growth? There's all the data suggests so, and I guess this is why this sector is quite attractive.
Okay, well let's talk about some of the headwinds. Data centers are facing a perfect storm of challenges, including access to capital, supply chain disruptions, limited power availability, land scarcity, evolving regulations, and pressure to operate sustainably. So let's first tackle the issue that's on everyone's mind, power. Power availability remains a bottleneck for data center development across APAC. So, Marcin, how are power constraints and exploration of alternative energy sources influencing lending decisions and the terms you offer for data center financing?
So, look from a financier perspective or finance industry more broadly, right? The role we're playing here is much the same as the role that infrastructure developers are playing for their customers, so solving problems and issues that they faced in entering new markets and building capacity in those markets. From a finance industry perspective, we see our role as somebody that helps devise financing structures, that helps find sources of capital, diverse pools of capital to help our clients finance the developments that they're pursuing. Now, what has changed and is evolving is that a lot of these developments today include some form of investments in power infrastructure. It will likely transition to investments in power generation assets, which will be the same shared shareholders. So what that really creates is a dynamic where you do require a lot more capital to find its way towards those developments to effectively allow for the deployment of capacity that needs to be built. Power is a tremendous challenge. I think it's a challenge that we all face globally. I think what we need to recognize is hyperscale deployments are in a lot of ways solutions to the power problem. It is today the most efficient way of turning power into data. It is far more efficient proposition than what we had seen historically in terms of governments, enterprises developing compute capacity in-house. So we see hyperscalers as a big part of the solution to the power problem, rather than the source of the issue at all.
All right. And then you recently joined AirTrunk and proved you had a 20-year banking career. So, from asset-backed securities and project bonds to other innovative models, like what kind of financing mechanisms are emerging to mitigate capital-intensive nature of these gigawatt campuses?
No, thanks, Miles. So I think when we talk about gigawatt campuses and my fellow panelists have talked about the growth and the demand. What we really need is more capital. And I think at AirTrunk, as you probably heard from Robin's remarks yesterday, I think sourcing capital is one of the things that we are very focused on in terms of making sure that we get speed, scale, reliability of capital, efficiency, and also sustainability. I think that's how we approach financing at AirTrunk. And when we talk about, I guess you mentioned a couple of these options. Realistically, I think what we are expecting, and I'm pretty sure that my fellow operators will say the same, that probably at some point, the bank market, the traditional bank market here in Asia Pacific, we're going to hit the limits of what banks can do. So we are on an active lookout for alternative sources of financing in the debt capital markets, bonds or private credit. I think just on ABS, I think that's a really interesting product that we think is worth exploring. I think in the data center markets in Asia Pacific, I think we have the benefit of looking at the US as an example, because they are so much more developed than us. And if you look at the US data center market today, quite a lot of the growth is being financed by the ABS market. Last year, I think about $6.5 billion was issued in asset-backed securities, just for data center operators. And that's out of a market of $270 billion. Just in the first 6 months, I think about $4.7 billion have already been tapped out of market size of 170 billion. If you look back in Asia, I think there's pretty much no opportunities for bond investors in the data center space. But the Australian securitization market issues about 30 or 60 billion of ABS every year. So there's a good opportunity there, something that one of the options that we'll be considering.
Sam, can you share some specific examples of how EdgeConneX is addressing power challenges in APAC? Are you guys exploring on-site generation, renewable energy partnerships, or any other kind of innovative solutions?
The simple answer is really all of the above. It's a combination, and every market has its unique challenges. The access to renewable energy are the power markets mature enough to be able to support the scale and the requirements of both ourselves and our customers. But one of the things that EdgeConneX has been focusing on, and we have real life tested products, is I'll use Dublin as an example, where Dublin very early on became a hot one of the key European markets for data centers, for hyperscale data centers, and Power Grid really felt that in their ability to deliver. We have a customer contract in hand, we have our RFS state that we need to commit to, so we took the bold step to self-generate our own power. That concept has then grown to what was originally planned to be a temporary power source to now a permanent power source at major scale, upwards of in excess of 100 megawatts in the facility. So that sort of innovation is what's required. And mirroring what Edmund said earlier, the scale at which we're operating at, and coupled with the fact that the speed that our customers is required to deliver product to market, a lot of these markets that we see today are power constrained as it is. Then you add on the 16% projected CAGR growth across the world in terms of capacity over the next 7 years. It just becomes a real power grab, and grids around the world are being constrained. big benefits of that market was that they were operating at a 20% surplus on the grid. Well, in the past 12 months, there's been something like 4 gigawatts of applications being submitted. At some point, they will reach a tipping point where they just can't provide the capacity anymore. So then we have to look to alternative sources, including renewables.
So what are the most viable alternative energy sources you see today in Asia?
Yeah, that's a good question. I mean, it's really the challenge that I see is that with these AI data centers that we're all looking to try to develop and design, it went from 3 years ago, are these data centers too big, to now how big can we make these, right? You see really interesting and quite radical things happening in the U.S. like Microsoft on 3 Mile Island. They're taking a decommissioned nuclear reactor, switching it back on and trying to deliver 800 megawatts that directly pipes into their data center. So, unfortunately, I don't know the answer to that because, again, the scale at which we're talking about, it really flips the narrative, and I think the market really has to figure out how to respond to this massive amount of growth and demand.
And is anybody thinking about whether or not there's going to be a difference in energy rates? Consequently, runways differing by different types of energy sources?
Maybe if I can take that, right, I think from our perspective, the key consideration that infrastructure developers and operators are solving for is first and foremost availability of power. Right, this is the key. Now, ideally, that power is sourced from green sources. Ideally, it's a sort of carbon optimized proposition, but the availability of it is absolutely paramount to dictate where the development efforts are focusing. It is true that power is, in most cases, a pass-through to your end customer, and the total cost of ownership and effectively the electricity bill that they receive is important to the consideration. But in the current environment, with power being a constraining factor, we're seeing an approach where developers and their clients are willing to go to any location that has power available, that is scalable, that can be delivered to again provide maximum amount of compute in the shortest amount of time.
Yeah. Data center or power-hungry facilities. How are you guys, on the panel here, addressing environmental impact of these data centers? From an ESG and sustainability perspective. Are you seeing increased demand for, like, say for example, Marcin, are you seeing an increased demand for green financing or other sustainable financing solutions?
Absolutely. Look, and ESG is driven from a number of sort of angles, right? This is a requirement of the ultimate customers. This is the regulatory environment. This is a set of KPIs that we work as financiers with our clients to assure the facilities that are being built are solving for the environmental and social and governance issues altogether. Now, I would offer a perspective that ESG had become a sort of de facto standard, but it's also an opportunity for operators to distinguish themselves from other operators that are not paying as much attention or are not as sophisticated in devising the structures that really show commitment to the same objectives that their customers and the broader communities are signing up for. So I think ESG is certainly a necessity, but it's also a point of differentiation for DC operators.
Just from AirTrunk's perspective as well, and just going back to the headline on Avant-Garde financings, right, which new and novel ways of doing. I think for AirTrunk, with respect to ESG-linked financings, I think it's something that we've been a core part of our DNA to be a sustainable and responsible data center operator. I think we started our the first sustainability loan for a data center operator in Asia Pacific back in September 2021. And then last year we did 4.6 billion sustainability loan to refinance that. But also I think it was the largest in the world for data center operator. I think we want to do that because we believe that capital is one way of making sure that we are accountable. And so we do set these KPIs. I think we had 5 KPIs in the sustainability report that we did last year that covered not just the environmental aspects, so power, water usage, carbon effectiveness, but also the social part of it, so gender, workforce, equality, reducing the pay gap as well. And I think these are the things that we really believe that would help the community. One interesting thing about how we've also gone about this is that these sustainability loans tend to have margin reductions if we hit the KPIs. Now at AirTrunk, we actually don't pocket the margin savings that we have. What we do instead is that we reinvest this in a social impact program that we rolled out. And this social impact program basically takes the funds and reinvests it into the communities that we are operating in, focusing on areas like STEM education, biodiversity and conservation. So one example is that in Japan, the interesting thing about it is that the level of STEM education between men and women is actually quite different. I think that was probably brought up in a panel yesterday. So what we've done is that we've actually worked with a university in Tokyo to provide STEM scholarships to women and using proceeds from this social impact program that we've made from hitting the KPIs on the sustainability loans.
Okay, thanks for that. And then, Marcin, as we talk about green solutions, how does location selection intersect with the availability of green solutions?
So again, right, in an ideal scenario, you go to places where green decarbonized power is available, and I think those are the choices that the operators are trying to make within what's available. This is, the green power sources are different depending on which geographies you're looking to locate the capacity. There are various technological solutions to help increase the effectiveness of the capacity you're building. But again, today, I think we all recognize that what dictates where you look to develop, acquire sites and develop these things is really where power is available, and then where there is a visible path for scaling what's available today to cater to the exponential growth in capacity that we need to deliver. So choice of power, green electrons is absolutely important, but there is a sort of higher order of priority in just securing power first and foremost.
And there's also land scarcity. With land scarcity, is pushing data center developments towards emerging markets. So, Sam, how is EdgeConneX approaching site selection in emerging markets? Are there specific criteria or considerations that are particularly important in these regions?
Yeah, I think I'd like to say that there's some secret sauce that we have that that gives us an advantage, but ultimately, as we get to scale, as we moved on from hyperscale to now the common terminology of exascale. As Marcin mentioned, once you get to that big scale, you have to. There's no way you're going to be in any CBD location or remotely close to that. So that then opens up further opportunities for renewables, right? And so some of the conversations we have with potential partners are, if we as a data center operator needing anywhere from 500 megawatts to upwards of 1 gigawatt of power, it really opens up the opportunities to partner with power producers who are trying to rationalize and finance a power project. So how great would it be if you're a 500 megawatt off-taker to de-risk your 1 gigawatt solar panel wind farm? And so I do think with this explosive growth of the AI data center requirements, it will help drive a lot of these initiatives. And then more so than underpinning your ultimate question, the access to capital, having the flexibility, both having equity that's motivated, that believes in the cause and understands your business model, then opens up the capability to raise the debt. And one of the things at EdgeConneX that I look back and attribute to the successes that we've had to date is that, we can go out and get the land, we can go out and get the power, we know how to design and build it, we know how to procure. But, what is the real true differentiating factor is our ability to finance these large projects in a very short amount of time.
So let me ask, a lot of developers have that secret sauce, right? Copy paste, right? So if you copy paste a 100 megawatt facility in the primary market and you plant that in the tertiary market, Marcin, how are you financing and how are you differentiating between locations?
So I don't think there's a sort of huge degree of differentiation, right? We are by far sort of working with established operators and developers who have long track record of delivery capacity. There is obviously a big sort of effort and scrutiny around due diligence of projects that we're ultimately financing, but it's all backed by the efforts of many people and consultants to make sure these projects carry risks that we are ready to underwrite. I think if you look at the sort of developments and how data center network topographies are evolving, these are becoming truly sort of regional or globally connected data centers with ability to move data to locations where power is available, to move data to locations where green power is available, and so I think we're seeing this as a truly sort of global construct, and the financing mechanism that we're using are in a lot of ways replicating the best practices we've seen and deployed in markets like the US, Europe, and we're sort of bringing that know-how into Asia, and it's all about sort of finding diverse sources of capital to complement the bank that is required and very well established to finance the sort of early developments, but then effectively tap into capital market solutions, securitization, to increase the amount of overall capital that is required. And that's on the debt side. Now, on the equity side, right, there are a number of solutions and possibilities to address those issues. And it ranges from co-investment opportunities, bringing additional capital to complement the capital that the sponsors have committed to the project. This is about looking at reallocation of capital across different risk rewards pools. So you're seeing emergence of trends of splitting the data centers into sort of established DevCo or development sort of arms and YieldCos that carry the fully sort of utilized assets. So there's a number of ways to solve for capital, and we're working with our DC operator clients to find the optimal solutions for their needs.
And when we start talking about secondary, tertiary markets, we also have to think about data sovereignty and geopolitical risks. Those add another layer of complexity to the data center development. So how are you guys factoring in data sovereignty, compliance, and geopolitical risks in your due diligence process?
Look, I think that's all part of the overall risk assessment. I think again, I keep coming back to the same point. As the scale and the quantum of the investment starts to increase, the risk factors need to be not only mitigated but shared across multiple different parties and partnerships. Geopolitical risk is real. It's big. If you take one of the world's largest buyers of data center capacity today, as we all know, ByteDance, one of the interesting dilemmas that we have is, you have a company, at least in APAC, who is one of the biggest buyers, yet they are caught up in geopolitical risk. They're not as transparent as we would like to be from a financial perspective or an internal operations perspective. And so, but yet they're the ones driving a lot of the growth. So you want them, you need them, but how do you finance these projects? And I think, I don't have the answer, unfortunately, but these are the daily discussions that we have as we're trying to underwrite these deals, and knowing that there's intrinsic value in these customers and these clients, but the ability to take that contract or the bankability of the covenant and actually get the financing required to build these multi-billion-dollar facilities, it is a real challenge today.
All right, let's stop right here. Does anybody have any questions before we go on to the next topic? Anyone from the audience? We'll go on to the next, quote unquote headwind. So let's talk about supply chain disruptions. They continue to pose challenges for the data center industry. So I want to know how the panelists are mitigating risks. So Marcin, how are supply chain disruptions impacting project timelines and budgets? Are you adjusting your financing terms and requiring strong contingency plans from your borrowers?
So I think yes, right. We are looking to again provide financing solutions that are flexible and that reflect the reality of the market that is changing very rapidly now. Again, what we've seen repeatedly from our clients is there is a tremendous amount of again prudence and long-term planning to make sure that the RFS dates that the operators are committing to their clients are adhered to and effectively delivered. So a big part of that is access to supply chain, which does pose sort of challenges in terms of constraints for long lead equipment items. To some extent, the new technologies like immersive cooling. This is something that's even though technology from sort of 2 decades ago, but it's gaining popularity, and so there is I would say, supply chain constraints in terms of what's available by when. And now, in short, right again, we so far haven't seen much delays in terms of project delivery, but financing arrangements allow some flexibility for delays to again make sure there is a redundancy built into the structures to reflect what could be a risk factor.
Okay, thanks. Sam, how is EdgeConneX navigating supply chain challenges and ensuring timely project delivery? Are you diversifying suppliers, building inventory buffers, or adopting mitigation strategies?
Yeah, so the key answer to that is to make sure we move the planning process upstream as much as possible. Diversification of your supply chain is paramount. We're in the industry of providing redundancy, and we have to have the ability to go to multiple sources to procure the equipment that we need. One of the things that we've done is we entered into strategic partnerships with suppliers, particularly a lot of the long lead items like generators and transformers. So that's one part of the equation. The other part of the equation is actually, again, is financing, right? The traditional financing of get the customer contract, make sure it's a creditworthy, and then you go out there and try to project finance it or roll it into the portfolio. We're trying to move away from that and explore pre-lease type of financing that gets us the ability to actually commit to and essentially write the check to procure a lot of these long lead items. Again, what's happening, and again, you'll see it happening with any sort of huge spike in demand that happens in a short amount of time, the pressure to deliver that product to market continues to decrease, right? So we have to find ways to deliver your product to market quicker and sooner. And I think, in due course of the next 12 to 24 months, it's the platforms that have the ability to combine the ability to deliver quickly, to procure equipment quickly, and more importantly, to deploy capital to commit to those contracts quickly, will find themselves in a pretty favorable position.
Well, let's fast forward like 5 years from now. There's a massive amount of data center projects underway, and the power situation hopefully will resolve itself over the next several years. There are concerns about potential oversupply in the future. How are you assessing this risk? So let's start with Marcin. How are you evaluating the risk of oversupply in specific markets? Are you factoring this into your lending decisions?
So look, I think in terms of evolution of the market, I think it's a reasonable assumption that in a few years in Asia we will be where the more developed markets in the US and to some extent Europe are today. So what that translates into is a lot more strictly dedicated AI deployments, a lot of deployments getting closer to that sort of half a gigawatt mark or perhaps larger. A lot of deployments that include some form of clear alignment with power generation assets and transmission, deployments that include battery storage, hydrogen, and new technologies continues to again increase the efficiency and optimize for sort of ESG factors in that. We will certainly see a lot more participation of partnerships with DC operators to help them address and solve some of these issues. On the capital side, we're hoping to see, to the point Edmund alluded to, a lot more receptiveness from capital markets, securitization markets towards projects and issuers out of Asia. And we feel what is required is the sort of quality of operators that we see today in the market, really opening and creating that avenue. So I think a lot more diversity, a lot more scale, but there is no doubt in our mind that again the demand trajectory points towards a huge scale for which both the operators and infrastructure builders as well as financiers will have to find ways to accommodate.
Edmund, how is AirTrunk mitigating the risk of oversupply in its development plans? Are you closely monitoring market demand, focusing on niche markets, or adopting any other strategies?
I think what we can say is that we expand only according to what our customers want. So we don't build speculatively. We don't go into a new market without having an anchor customer contract. So I think we've been always very disciplined in the way we expand, and I think that will be how we will continue to operate. I think with respect to your earlier question on looking forward, and obviously oversupply is something that I don't think anyone can really predict. But in 5 years' time, I think we're going to be hitting close to our 2030, which at least for AirTrunk, we have net zero commitments for that. So echoing what Marcin just said, I think it's about continuing to develop data centers that are energy efficient, water efficient, that use low carbon intensity, exploring energy solutions, renewables, on-site battery storage. I think these are the things that we are all working hard to develop as well. And then on the financing side, really it's about I believe deepening the education in the market as a whole. I think the more investors better understand the sector, especially our hyperscale business, I think the capital markets in this part of the world will be a lot more efficient.
And Sam, how is EdgeConneX addressing investor concerns about the potential oversupply? Are you confident in the long-term demand for data center capacity, even if AI adoption doesn't meet expectations?
Yeah, so I think I think the question about the long-term demand, we're quite confident that the runway is long enough that the risk of oversupply, or at least specific to our pipeline of supply, is not a huge risk. But one of the areas that we do focus a lot on is technical obsolescence. I mean, that is the rate at which our technology is developing, and if you just take data center design, when you look at the AI data center, it's gone from 3 years ago going from 3 kilowatts to 5 kilowatts a rack was a pretty drastic densification exercise, and now we're talking about 120 kilowatt Blackwell chip servers, and this is all happened within the past 3 years. You have this incredible densification of the racks, but the other challenge is that there is no generally accepted design. You don't have a lot of these deployments that say, oh, A works, B doesn't, C works. And then there's a whole downstream effect of how do you operate it, how do you maintain it, how do you repair it, what's the useful life of the product, and where does the risk factor lie, and who's holding the baby when there is a, God forbid, such as a failure event. Those are all real questions that we think about, and I think personally for me that's the bigger risk. So how do you mitigate that? Again, you have to build flexibility into your design. Understanding what trends have been in the past predicts what trends will happen in the future. So when we talk about not just the building envelope, how big do you make it, where do you put your plant and equipment, that's one element, but the bigger element is to understand what are the different types of design applications that are available. So how do you get that? One of the things that EdgeConneX does is we work very closely with one of the, obviously the world's leading AI chip producers of NVIDIA. You sit down with them and understand, hey, what are the issues that your customers are facing? What solutions have worked for you, what haven't? And you have to work closely with the chip providers and customers, but also with the suppliers to understand what is the optimal situation. But again, I do think flexibility is the key, because in 5 years' time, I assure you, it will be something very different than what we think it is today.
Well, before I ask you to bring up your crystal ball to talk about what's going to happen in the next 5 years, I want to touch on the last topic, unless anybody has any questions in the audience. Over here. This gentleman.
Hi, thank you, Bertrand from Natixis. Piggybacking on what Sam told, and it's great to see, not the beginning of the question, that EdgeConneX and AirTrunk are really forward-looking. It's more a question for you, Mike, as you are an expert in the data center and the life science lab valuation. Do you see this obsolescence risk getting bigger and bigger and really fragmenting the market going forward, where you will have on the one hand very large operator like AirTrunk and EdgeConneX really being able to retrofit constantly their assets, and a part of the asset no longer being fit for purpose in a few years' time?
I don't see obsolescence risk. If you look at what backups power, the data center, they're the same technology that's been used for since mainframe computers, like backup generators. So I don't see that type of obsolescence risk. I see the risks are putting large mega campuses in tertiary markets. A lot of the banks that ask us to do the valuations ask us for the downside scenario. What if the tenant didn't move in? Right? What's the downside if it were to go dark? So that would be the question. Is it in those tertiary markets? Is it one and done, or can it be released? So that's the issue that I see. Okay. Okay. Any other questions in the audience? Okay. So let's go for the last question. So exit strategies. With the increasing scale of data center campuses and the complexities of public market expectations, we are likely to see a shift in exit strategies. Will we see more strategic partnerships, partial stake sales, alternative financing models to bridge the gap between capital markets and market demands? How are you guys approaching this issue? I'll leave it open for any of you to answer.
So maybe, Miles, this is a good place to start is kind of looking at where the industry is overall, and what you see overwhelmingly across all the geographies is rather than exits, you see a lot of capital finding its way to the data center industry to support, again, the demand that we see that needs to be developed. So I think we're still a few years away from big exit considerations. Now, some of the transactions that did happen in this space across all markets, again, sold for capital that has to be made available to fill the sort of pipelines that the operators have been developing. Now, the flip side of this, and it's maybe partial exit, is again, how do you allocate capital to the right yield and risk proposition? And again, here we see a lot more activity around the devcos and yieldcos about making some of the data center business proposition available to real estate investors, to long liability cycle insurance funds that can come in and support capital at scale and not necessarily take the development risk or risk of building and commercializing those assets. So we see a lot of pools of capital coming into the industry. It is certainly one that stands out as an industry that has tremendous volume of capital and tremendous growth rates, all sort of right as part of the equation as we see it today. So we see a lot more capital flowing into the industry before you start to see exits or considerations around monetizing those assets.
Okay. So before we close, I want to ask each of our panelists what their forecasts are for the next 5 years.
Well, hopefully we'll meet again at Tech Capital.
So for me, I you know, if you look at APAC as a whole, it's still quite underdeveloped. I feel excited for the region. I think there's still a lot of infrastructure development that we'll see over the next few years. You know, every time you come to these events, you go around the room and you speak to people, and not only is the pool of people getting more diverse, the level of interaction and expertise that's happening is incredible, right? Just as much as data is exponentially growing, the expertise around this room of the industry is continuing to grow, and that makes it quite challenging and exciting at the same time. And I think, you know, we're all, you know, friendly competitors at the end of the day, but I think it helps push each other to, you know, do better, to be, you know, grow not only to meet our customer needs, but do so in a sustainable way. I do think I look forward to really seeing the industry step up and ensuring that, you know, we are socially responsible while also meeting the needs of the customer.
Yeah, I mean, echoing what Sam said, I think we all want the industry to grow and develop into a more mature state. With respect to that capital raising, I think that's part of it, you know, to be able to support that growth that we're going to see, the exponential growth that we're going to see in the next 5 years requires a lot of capital to support that. So in 5 years' time, that capital, very hopefully, today I think there's probably about 4 banks that are present. I'm not sure about bond investors, haven't met any, but maybe in 5 years' time, you know, there'll be a lot more diversity in terms of banks and bond investors and other private credit participants as well.
All right. Well, thanks everyone. Thanks for joining, and congratulations to all the winners last night.